Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this BCI podcast number 39, titled Using the CBOE Volatility Index, the VIX, for Strike Price Selection. Now, most of us have listened to TV and radio broadcasts regarding the stock market, and we always hear somebody talk about the VIX. The VIX has gone up, the VIX has gone down. And we have a general idea what the VIX is. It's a display of market volatility, but do we really understand how the VIX can impact our trading decisions as option sellers? In this podcast, we're going to define and explain the VIX. We'll have a look at it in both extreme and more normalized situations. And then we're going to talk about how it impacts our trading decisions. So let's get started with a definition or an explanation of what exactly is the VIX. Well, it's been known as the CBOE Volatility Index, the investor fear gauge. It has a lot of names. Most people know it by the name the VIX. And it's the market expectation of the upcoming 30-day volatility. How volatile will the market be in the upcoming 30 days based on the pricing of call and put options. Implied volatility, in other words. It's not historical or back-looking, it's forward-looking. Now, the VIX, or implied volatility in general, is based on one standard deviation, which means implied volatility in general has an accuracy of about 67%. So it's certainly critical, but it's nothing we should hang our hats on as the sole indicator in our decision-making process. It's also based on 1 year. So if implied volatility is 25% and we sell a 1-month option, that does not mean that the anticipation is that the price of the stock is going to move 25% in either direction over that 1 month. It's an annualized expectation, once again, based on one standard deviation. So it does measure risk, market risk, and that's why it's known as the investor fear gauge. Now, the higher volatility, in one sense, is good because the premiums we generate when we sell our options will be greater because the greater the implied volatility, the higher the premiums. But the downside is that we're susceptible to greater risk if the price should drop, because implied volatility does give a statistic, but it doesn't give a direction. So 25% IV could mean in either direction, higher or lower. And so there's good news, bad news associated with higher implied volatility. Now, if we're going to take a look at an extreme example, if we looked at a chart of the VIX in 2008 when we had that horrific market crash, we would see that the VIX went from 15, fairly historically low figure for a while, and it went all the way up to 80. It touched 80. So more than 5 times within a 4-month period towards the end of 2008. So you can imagine what was going on during that market crash, because panic had set in, and that's not good for conservative strategies like covered call writing or selling cash secured puts. Now, in 2008, as the VIX was going to the moon, the market itself was plummeting, as you know. So there is an inverse relationship between the VIX and the overall market. So generally speaking, when the VIX goes higher, the S&P is going lower, and vice versa. So a higher VIX, although it does mean greater premiums for us, generally speaking, is something that is not our friend. Again, if we are interested in conservative option selling strategies, that means we have capital preservation in mind. We're a certain type of investor. We're not susceptible to higher risk. That's not what we're looking for. So we have to take certain steps to mitigate when the VIX is extremely high. Now, if we were to look at the post-crash after 2008, the next 5 years moving forward, as you know, the market took off. It ended up going much, much higher. So what that means, we would expect then for the VIX to move much, much lower. And that's exactly what happened as the market appreciated, almost doubled as the VIX went down by 70% in those ensuing 5 years. So once again, that does reflect the inverse relationship. And if you look at times when the market was particularly spiking higher, you would notice that the VIX was particularly spiking lower, and vice versa. Now, we took a look at the charting of the VIX and S&P from 2017 to 2020, and the same thing holds true. That inverse relationship is like money in the bank. We can count on seeing that no matter what time frame we're looking at. So once again, a spike in the VIX, the market goes down. The VIX plummets, the market goes up. So that kind of tells us that based on what the VIX statistic is at any given point in time, that will impact our trading decision, not as the only criteria to use, but one of the criteria to use. So if we have bullish, bullish, bearish, bearish, and the VIX is bullish, that might throw us in that direction. So once again, we never hang our hat on one particular threshold, one particular statistic. We use a myriad of statistics, and the VIX is just one of them, but it's an important one. So let's look now how we might trade if the VIX is historically high and we're using covered call writing. Well, we want to mitigate the risk to the downside, so we're going to use stocks that have a lower implied volatility. Now, this is going to impact our time value return because we're using stocks with lower implied volatility. So we might have to adjust our goal, our initial time value return goal range. We might have to adjust that down based on the fact that the VIX is higher and we want to mitigate. So if, let's say, our 1 month goal for near the money call options is 2 to 4%, we might drop that down to 1 to 3%. We're going to tweak it a little bit in the lower direction to mitigate the high risk in a market like that. Now, we also might favor in the money call options to give us additional protection to the downside, as well as deeper out of the money put options, once again, for additional downside protection. So you could see how we're crafting the strategy to meet what's going on right at this particular second. High VIX, we use in the money calls, deeper out of the money puts, lower IV securities. And so we're crafting the strategy. Now, it might change the next contract month, but that's what's appropriate at this particular point in time. As a secondary threshold, we might look for stocks that historically have low beta. They react, there's less volatility compared to the overall market. So that's a secondary consideration. And finally, we might consider using exchange-traded funds instead of individual stocks because, generally speaking, not always, but most of the time, ETFs have lower implied volatility than do individual securities. Now let's look at the other side of the coin. What if the VIX is low? Well, if the VIX is low, then typically the S&P 500 would be appreciating. So we're in a more bullish environment. So we would then think about stocks that have a higher implied volatility, so we could take advantage of the market conditions. We might set slightly higher initial time value return goal ranges. We might take 2 to 4% and move it to 2 to 6%. Now, we would favor out of the money call options because there we can generate 2 income streams per trade, option premium and share appreciation. And maybe just go slightly out of the money on put options to get higher premiums. So these are some of the things we could do to craft our strategy based on a lower VIX. We also might look at historically higher beta stocks. Again, a secondary consideration. And here we might favor individual securities as opposed to ETFs because they generally have higher implied volatility. So, it's the opposite from what we would do for a high VIX. So let's summarize now. The VIX should be used as one of the several factors we use in our option selling decisions. I don't want you to think that any one of our criteria is major. It's a mosaic that we're painting to indicate to us the best way to craft our option selling strategy that particular month. And it may or may not change the next month, but we know what to do and how to do it based on what's happening at this very second. The VIX should neither be feared nor embraced, but rather managed. And we just went through this podcast on how to do so. Now, historically, and this is a key takeaway, the VIX has been inversely related to market movement. So high VIX could mean higher premiums, that's good, but more risk, that's bad. So understand the VIX, manage the VIX, take advantage of your knowledge, and that's what makes blue-collar investors elite option sellers. Just as a reminder, we have a lot of free resources on www.thebluecollarinvestor.com website. On the top black bar, we have the free resources link. We have calculators there. We have various files there. So feel free to download those directly to your devices. Plus, we have in our Blue Collar Investor store, we have books, ebooks, DVD programs, calculators, spreadsheets, trade planners, online mentoring. So there's a lot of information we have available to you to help make your option selling trades the most successful that they can be. I want to thank everybody for taking the time to listen to this podcast, BCI podcast number 39, using the CBOE Volatility Index, the VIX, for strike price selection. Folks, I hope you enjoyed this podcast, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.